If there's an age gap between you and your partner, there is an opportunity for your retirement planning, and I thought I'd go through that today. You may know with superannuation is when you get to retirement, you don't pay any tax on anything that it earns. So for example, any investments, whether it be interest or rent or dividends, you don't pay any tax. So I guess the idea is we want to try and get to that zero tax as soon as we can. So what we want to try and do as a strategy is move as much money or our superannuation money to the person who's older. However, with superannuation, there are a few restrictions, so I thought I'd just go through those with you. With superannuation, I call it like the above ground swimming pool here, where there's two ways to put money into super. One way is via a company or by salary sacrifice, or where you put money in person and you claim a tax deduction. The other way is where you put money in personally. Now this strategy is all revolving around contributions that have come from a company or where you salary sacrificed or claimed a tax deduction. What basically the government allows us to do is contribute into super. Here, let's just say this is sort of the younger person, but what happens is we can then transfer the money to the older person's superannuation account. Now just to understand, when money goes into super from a company or we were claiming a tax deduction, 15% tax is taken out. So we call this superannuation splitting. If you avail yourself of this strategy, we can move it from the younger person's super to the older person's super in any given year, but it is 85% of the contributions. Now the reason by that is because 15% of tax has come out. But you can imagine over time, that can add up to a substantial amount. And when you get to retirement, that money is hit the zero tax faster. So I hope this helps. There's a lot to this strategy, so I'd highly recommend that you reach out and get advice, and we'd love to be able to help you.